Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors, and I am joined, as always, by the wonderful David Kroll of Mortgage Network, and we are here to discuss all things where your money matters. And we have had, I don't even know if we're going to have anything to talk about from here on out, but we've had a very, very exciting last week. I'm sure there are lots of you that are as bleary-eyed as we are from staying up late on Tuesday night and then seeing the reaction among the markets and the newspapers, or the lack of reaction among certain elements. It's just been really, really, really interesting and exciting, regardless of which way you preferred for the polls to fall. So, that said, just in a quick recap to cover what it is that we're supposed to cover, and then we can go on to cover whatever we're feeling like we're going to cover today. But surprisingly, not surprisingly, on the night of the election, of course, the equity futures tanked down about 800 points. At somewhere around 2:30 in the morning, the Dow was down, the futures were down about 800 points. What that basically means is that trading overseas that was going on was just extremely uncertain and extremely volatile. It was one of those oh my gosh moments in overseas markets, primarily for those that could trade at 2:30 in the morning. On just concern of this is not what we expected. This is the same thing like we were talking about last week, going back to when George Bush and Al Gore had their oh my gosh moment with the hanging chads and the pregnant chads and all that stuff in Florida, and the markets were negative during that period too. This was obviously a huge boom and back up, very similar to Brexit. It's been equated to that by several pundits. So that was interesting, and then by the time the markets opened up again, maybe down 200 points, and then we've had a run for the last couple of days. And that is really based on, well, who knows exactly what it's based on, obviously, but the expectation that if now President-elect Trump does what he says he's going to do, if the policies that seemed a little hazy in the past, I'll go ahead and give you your due, seemed a little hazy in the past, do come to fruition, the few that could come to fruition more quickly would be things like a reduction in corporate tax rates. And also we're seeing interest rates jump up a little bit. And the impact that those two things have on companies, on publicly traded companies, are tremendous for cash flow. And just think about it, if you didn't have to pay as much money to Uncle Sam in taxes, you'd be sitting on more discretionary income, and you'd go out and you'd buy more clothes, or you'd buy a new car. I mean, all of these things are stimulative. And that's one reason. The other, with interest rates going up, is that pension funds are going to be easier to fund because they're going to be able to generate these massive pension funds are sort of a big overhang on large corporate balance sheets, and if they're not funded, then it's a great big debt that they're going to have to fill, and they've had to pump more money into those pension funds because interest rates have been so low. Interest rates go up, they don't have to pump as much money in because they're making money on their money. Again, hopefully, maybe still low, but whatever. Either way, more cash that falls to the bottom of the corporate, the corporate P&L, and they're able to invest it, hire, share buybacks, you name it, whatever it might be. It's still higher dividends. All of that is positive for publicly traded companies. Positive for all companies, but it's positive for publicly traded companies. Thus, this run that we've seen in equities in the last few days. But who the heck knows? I mean, it could all reverse itself, because of, one misstep with Iran.
I'd like to emphasize the who the heck knows side of that.
I said that really well.
Yeah.
It was very professionally said.
The who the heck knows, the market, the uncertainty is profound, but it is not present in the market itself at the moment. The market is choosing to believe that the net effect of the Trump presidency is going to be stimulative. Trump has come into office essentially without policies, without articulated policies. They're, to the extent that we understand any sort of broad brush likelihood of policy, as Emily said, lower tax rates would be one, lower business tax rates would be one, lower tax rates on the corporate tax rates and the wealthiest individuals will both get tax breaks. And there will be stimulative, that's very stimulative, there will be very stimulative policies and projects as well. Trump, to the same extent as Hillary Clinton, and perhaps even more so, is a builder. He is not tied to traditional conservative principles. If somebody says, let's build $50 billion worth of roads and bridges and airports, he'll say, hell no, let's build $100 billion. And if somebody else says, well, $100 billion is a little cheap, he'll say, fine, let's build $150 billion. He doesn't have a long conservative ideology. He was a Democrat 4 years ago. He's not policy bound. He's reactive. He's everything that everyone.
Well, you could also say he's production bound. I mean,
he's production bound, but he's driven more by what he perceives to be the need of the moment. And this is my view, and my view is that the markets are filtering this and saying the net effect of it all is going to be highly stimulative to the economy. Now, there's a risk here. If this comes also with new trade policies and trade constraints, we could well see the flip effect. We could well see problems in the economy, because anti-trade policies have all kinds of unintended consequences.
True. It is interesting to see foreign markets rally, though. I mean, on the night of the election, overseas markets were down pretty sharply, at least initially, and then since then, all the overseas markets, whether it's European markets or Asian markets, they've all rallied pretty substantially. Japan especially, which is interesting, have rallied especially over, then I would say, on this news. Which part of the news? Not sure. Obviously, I think it has to do with.
That's the bit. We don't really know at this point what the basis of the rally is and what sort of long-term consequence, what the stability of the rally is.
Certainly, one argument would be that the rising tide carries all ships, right? And as we've said a million times, as inappropriately,
and it's a tsunami at the moment.
Right. Well, and as we've said, as inappropriately as we've said it in the past, and and to use yet another analogy, but what is it, the tallest, we've been the tallest midget or something like that? That's what we've been for 8 years now and running. So 8 years and running, and we've just seen Europe practically in a recession for at least the last couple of years and expected to even dig deeper into one with Brexit, and those markets have rallied. So it could just be, again, another analogy that here we are, we've been the strongest and we're going to be able to pull up the rest of the world market with it. Potentially, maybe. I mean, I guess the devil's in the details.
It hasn't played out. It's just so early, and what you're seeing a reaction to is the likelihood that we'll have economic growth, stimulative policies, a strong dollar. I mean, all of the things that lead to higher economic growth.
Inflation.
Inflation, which means higher interest rates, which means a more recognizable economy. It's not necessarily a better economy. It's a more recognizable economy. It's one where, as you say, portions of the economy that have been in a tailspin, like seniors trying to generate income on their portfolios, will return to a more recognizable economy where, because of higher interest rates, those seniors with a few $100,000 to generate income in retirement will be able to invest it and earn 4 or 5%. In the last couple of years, they haven't been able to earn 1 or 2%. So it's safely, yeah. So it's interesting. It's really interesting.
Well, one thing that we have seen, though, and again, we're only a few days into this, but we finally are seeing equities and bonds move the way that they're supposed to move relative to each other.
Right.
So we're finally seeing, as equity markets are going up, that the bond market, the principal, the price of bonds is going down. Mm-hmm. That's the way it's supposed to go. Mm-hmm. And those two things have been so linked and I guess incorrectly correlated or perfectly correlated for the last few years, and I think it's a good thing to finally see those things happening the way that we typically, historically, academically expect that they will. Anyway, we'll come back with more of that because I'd really like to discuss, and I hope you do too, the difference, what might be going on with our with our bond market relative to foreign bond markets and a few other factors.
I would like to do that because I always love talking about interest rates.
Yay! We'll be right back in just a second with more Money Matters. Please stick with us.